A very good morning, everybody. This is Khusbu Agarwal from SICASA, and I would like to welcome you all to the first day of CA Inter-SN. We can start, sir.
Fine. Thank you, Khusbu. A very happy morning, my dear friends. So the topic for the discussion today is strategic management, and I think many of you are already aware of it. The reason is this is going to be a fast track class, so we may not be able to cover in depth, but since this is a very small subject, strategic management is the smallest of all the subjects in the entire CA curriculum. So for that reason, I think even though we have only 5 to 6 hours of time, we can cover maximum of the content, because usually in the regular class itself, we will take approx 25 to 30 hours to cover strategic management. So 6 hours is a decent enough time for covering in a fast track manner. Before starting off with the subject, let me highlight few important changes, especially for the students who are coming from the old schemes into the new scheme. Strategic management used to be in 8 chapters earlier, 7 chapters before that. So those 8 chapters content has been condensed into 5 chapters. Some of them, I can say some 20 to 30% of the content has been removed, but additional new content has been added, and everything is condensed into 5 chapters now. And is there any logical order? I don't think so. There is any logical order for all the 5 chapters. You can pick and choose any chapter and then start your preparation. But however, we will mostly go with the logical order itself, or we might try covering the easiest chapters first. Okay. 5 chapters, everybody's question will always be, what will be the weightage? Usually institute doesn't provide chapter-wise weightage. It is a traditional practice, both in the olden days and I think before the revision, 3 to 4 times before the revision of the syllabus. Right from then, it is continuing as it is. Weightage will remain same for all the chapters. The weightage doesn't change. Every chapter will be of the same weightage. Every chapter will be of the same weightage, but the weightage doesn't change. So now the strategic management, since it is for 40 marks, you can approximately assume each chapter will be for 8 to 10 marks, considering the choice and other aspects. Each chapter will be for 8 to 10 marks. And there will be descriptive questions and there will be objective-based questions as well. But very importantly, by seeing the nature of study material for this attempt, for November 2024, May 2024 or November 2024 and subsequently, the very important change what we can observe is material has concentrated a lot on the case studies. However, this case studies is not something which is new for the strategic management. It is already there for 5-6 attempts inside the book. But this time the number of case studies and the explanation or the emphasis which is given for the case studies has significantly gone up. So you can expect lot many number of questions on the case studies when compared to the general content. But however, I'll always say my students, case studies are just, you need not separately study for the case studies as such in the strategic management. The reason is our ICAI, our institute, always expects even for a case study to write a theoretical answer. Basically, if they give one case study, you need to identify what is the scenario which is coming out from that case study. For example, let's say there was a restaurant. And that restaurant was operating for past 7 years. They had a strategy of having the good interiors, having good chef, having good hotel staff and everything. But suddenly COVID came in. When COVID came in, they made a lot of changes to their approach of operations. They suddenly introduced online ordering. They introduced contactless delivery. They introduced contactless payments. They said they added few new items into the menu, immunity boosters and all these things. They have added few new items into the menu. So this is one particular scenario which ICAI is giving in the question and asking you to say what is the strategic approach followed by this restaurant. Before COVID, they were doing certain things, and after COVID, they were doing certain things. What is the strategic approach? Now, for answering this question, maybe the first 3 or 4 sentences or the last 3 or 4 sentences will depend a lot on this case study. But for the rest of the answer in your question will completely be about any particular topic in the strategic management. In the current example which I gave, this topic is nothing but, this topic, this scenario which I was explaining you, it is nothing but a proactive strategy and a reactive strategy. The answer which you need to write is basically explaining that a part of the strategy was proactive and a part of the strategy was reactive. Whatever they have adopted before COVID, whatever they planned for good interiors, whatever they planned for good chef, good staff, good pricing, good menu, all these things were proactive strategies. However, suddenly in 2020 or 2021, there was a huge economic change, which they need to adopt on a reactive basis. They didn't have any choice. They adopted a strategy, but they were not able to continue with that strategy for whatever reason, COVID or whatever reason. So they were opting for reactive strategy. So now your answer will completely be about explanation of proactive and reactive strategies. So what I'm ultimately trying to say you guys is, though case study questions will be there, the case study questions should again be answered by connecting to one of the topics or more than one topic inside the strategic management. And since this is the first attempt after the revision of syllabus, there is a high chance that case studies will come directly from our study material. There may not be a new case study which will get formulated. Mostly 90% of the chance is there for the case study to be picked up from the study material directly. And other than that, see, this is one important aspect which you need to observe in the study material for sure, new case studies. And second aspect which you need to definitely focus on while preparing for the strategic management is about the new topics which got added into the content. So as I said, out of the 100% content in the old syllabus, they removed 30%, they added additional 10%, and some certain new topics. Whenever I am going in that particular chapter, I'll keep highlighting. I'll keep saying it. This is the new topic which got added into this particular chapter, and you need to emphasize more on that particular topic. The reason is it is added only now. It is added only now, and there is a high probability that it will be asked either in the May 2024 or November 2024. For that reason, it should be concentrated. Anyway, as I said, there are 5 chapters. Let us straightly jump into the chapter 1 of strategic management, introduction. As I said, there is no connectivity between the chapters, so we will start off with chapter number 1, and then slowly we will move on into the other chapters as well. Okay, chapter 1, it covers mainly definitions. Chapter 1 is all about definitions. See, this is a theoretical subject and especially management subject. So for that particular reason, usually the initial chapters will always be about definitions, and subsequent chapters we will start discussing about the game plans and actions. Anyway, in the chapter number 1, the first part, in the chapter, there are definitions relating to these aspects. Mainly, there is a definition of management, there is a definition of strategy, there is a definition of strategic management. So strategy, management, strategic management. Then there are definitions of vision, mission, strategic intent, goals, objectives. These are the main topics which we will be covering in the chapter number 1. If we cover all these definitions and understand the intricacies between these definitions, chapter number 1 will be completed. I'll quickly take roughly 1 hour to 1 hour 15 minutes of time to complete the chapter number 1. And our objective for today the session is approximately for 2.5 to 3 hours. My objective for today is to complete the chapter number 1, and apart from chapter number 1, either to complete chapter number 2 or chapter number 3, depending on the time. If the time permits us, then I will take chapter number 3. If the time is too short, then I will take chapter number 2. So depending on the time, we will complete another chapter. So concept of the management. The strategic management is a word which comes from 2 words, right? Strategy and management. So what is management? Very simple. Before going into the definition, you guys generally say me, what do we say management? What do we mean by management? Management means we usually refer to 2 things. The people who are managing the company are called management. Managing company in the sense any entity. Whenever I say company, it can be company, partnership, firm, sole proprietorship, whatever it is. Managing the business. The people who are managing the business are called management. And at the same point of time, the actions they perform are also called management. I am managing things is what we will say, right? The action I am managing. What do you mean by managing? I am planning, For example, I am managing my exams. I'm planning for my exams. I'm preparing for my exams. I'm ensuring that the syllabus is completely done before the exam. This is nothing but managing my exams. So in that way, there are two views for the management. One is people view, one is action view. People view. Simple, if I need to say it very simply, for a Reliance company, Mukesh Ambani is also called as management. Whatever Mukesh Ambani does is also called as management. What Mukesh Ambani does? Mukesh Ambani does planning, organizing, allocating, resourcing, controlling, strategizing. All these aspects which Mukesh Ambani does are also, those activities put together are also called management. And at the same point of time, the Mukesh Ambani and the people around him put together who are taking the decisions for Reliance, they are also called as management or top management of the company. So people view and functional view, not very important. Let us just, you can just go through the definition, we can skip it and then move forward. Then the second word, strategy. Management, we understood. Set of people who are taking the decisions, and even the decisions which they are taking and the activities which they are performing are nothing but management. Then the second word is strategy. What do you mean by strategy? Strategy is nothing but a plan, or strategy is nothing but a plan or a sequence of steps which are created, or a long-term game plan which is created by the management for the purpose of creating a competitive advantage. Simply speaking, the word strategy is actually derived from the war. Probably you would have seen the Bahubali film. In Bahubali, they discuss about a strategy called Trishula Vyuham. What do you mean by Trishula Vyuham? Strategy is nothing but Vyuham. In literal translation into Sanskrit or Telugu or Tamil, strategy is nothing but Vyuham. In Bahubali, they discuss Trishula Vyuham for killing the enemy. What is Trishula Vyuham? Kattappa will keep stopping the enemies from attacking us. On one side, Rana will go and attack, and on the other side, Bahubali will go and attack. This is a game plan which Ramya Krishna prepares for the purpose of attacking Kalakeya. I am talking about Bahubali 1. For the purpose of killing or attacking Kalakeya. Kalakeya is an enemy who is trying to attack our business or attack our empire. During that point of time, we have prepared a game plan by utilizing our resources. We implemented it in a particular way so that we can gain the competitive advantage and kill our enemy. In business, enemies are nothing but competitors mainly. So to kill our enemy and to achieve our objectives, they have prepared a plan and they have implemented that particular plan. It is nothing but strategy. Strategy is nothing but, it is usually a word which is adopted in the war for the purpose of attacking the enemy. In business, it is nothing but a game plan that is prepared by the management for the purpose of winning over the competition and for adopting the changes in the environment. These are the two main objectives for strategy. We should have strategy mainly because we should kill the competitor. We should be able to overcome. Kill in the sense we should be able to perform better than the competitor, gain ourselves a competitive advantage. In Bahubali, they gain competitive advantage by attacking from all the three directions. That is nothing but a strategy should always help us to gain the competitive advantage or to perform better than our competitors. And at the same point of time, whenever there is a strategy should help us. If at all, if there is any change in the environment, we should adopt it immediately and then go forward. For example, there can be many things which would have not been foreseen by the management. During that point of time, we should be able to adapt to those changes and then keep going ahead. If I need to come to the business context, for example, at the beginning of the session, I gave you the example of a restaurant, right? A restaurant was going on with a particular strategy. They had a good menu, they had a good price, they had good chef, they had good environment, they had good interiors. All these things were a particular part. But suddenly there was a change in the environment, which is COVID. During that point of time, whenever you are going ahead with the strategy, you will have clear intention. Okay, my intention is to achieve so and so amount of revenue. My intention is to achieve so and so amount of sales. My intention is to achieve so and so amount of growth. So when that is the intention, automatically when you are implementing the strategy, if at all, if there is a change in the environment, you will understand it. And this approach of managing the entity strategically with a plan will help you to adapt to those changes and keep moving forward. So that is nothing but strategy will help you to actually adapt to the changes as well. Basically, strategic management should mainly help the organization. Over a period of time, we will discuss more and more in detail. Mainly should help the organization in two things. It should help in building the competitive advantage. It should help in adopting the changes in environment. The reason is business environment is so dynamic. Every day there will be a lot of changes. So strategic management should ideally help you to adopt those changes inside the environment. Okay. From examination perspective, there are certain true or false statements which will be very important based on the basis of strategy. Definition is one part. There will be certain true or false or objective based questions which will be very important. See, whether strategy is a substitute for management. Can you say that if Mukesh Ambani formulates a good strategy for Reliance, can Mukesh Ambani leave the organization? Can he leave, resign from the organization and then go on? No, it is not possible because strategy is nothing but a plan on the paper. To implement that strategy, we need people. We need good, efficient management. And at the same point of time, strategy is not a one-time activity. There will be changes in the environment and somebody needs to adapt to those changes. Even for that, we need a sound and stable management. So we definitely need a good management. It is not that an organization has a very good strategy and if the good management can be substituted with the good strategy, no. Good strategy is required and at the same point of time, sound management is also required. It is not a substitute. The reason is good management is required for implementing that strategy and for adopting the changes in the environment. And at the same time, can you ask me, sir, if there is strategy, whether organization will become successful? If there is strategy, whether organization becomes successful? No. And will the strategies be perfect and flawless? No, not possible. I hope you guys remember the launch of Jio. When Mukesh Ambani launched Jio, initially for the first 3 months, they gave everything for free. They said it is a Dhanadan offer. And then they said for 3 months, voice free, internet free, everything is free for the first 3 months. Even OTT platforms, everything were free. For nothing they charged. Jio Cinema, Jio TV, everything was free. Nothing they charged for first 3 months. Mukesh Ambani thought, if I give free everything for 3 months, 90 days, automatically people will get accustomed to it. And after 90 days, they will start buying my plans. But what happened at the end of 90th day, people started throwing off their SIM cards. When Mukesh Ambani started charging money, people were not interested in buying it. So then what did Mukesh Ambani do? Mukesh Ambani said, okay, you need not buy any plan. You just pay me 100 rupees for Jio membership and we will extend this particular plan for another 90 days. So first 90 days were already free. For next 90 days, he charged only 100 rupees by saying Jio Prime subscription or something like that. And then he charged he gave it for another 90 days, which is nothing but Dhanadan offer. I mean, initially he called it as Dhanadan offer, then later he called it as Dhanadan offer. And he extended it for another 90 more days. Put together for 180 days, people enjoyed it for free of cost, almost free of cost. And then they were unable to leave Jio. They were still continuing throughout. So what I am trying to say you is, initially, Mukesh Ambani thought only Dhanadan offer. And he thought after 90 days, people will stick to me. But unfortunately, he reacted to the situation. His first plan had a flaw. Within 90 days, people didn't adopt. After 90 days, people were not ready to pay the premium price or a high price for the data or the voice. So then in that case, he launched something called as Dhanadan. Strategies can never be perfect, flawless, and optimal. Always you need to keep making the changes. The reason is strategies are always about future. If you want to say anything about past, you can say it perfectly, flawlessly, without errors. But if anything is about future, you cannot do that. So that is the reason why there will be always unanticipated scenarios, unanticipated changes in the environment. So for that reason, it can never be flawless. And strategies are usually formulated at 3 levels. We will discuss this subsequently in the same chapter. Anyway, strategic management is not a bundle of tricks and magics. People assume strategy is nothing but magic. Something happens just by chance. It is not a carefully planned action. It is like a magic. It is like mantra. I'll put abracadabra mantra and then it will happen automatically. No. Strategic management is a systematically planned activity. Just give me a second. Okay. I'm sorry, I'm checking my phone. The reason is if SICASA is messaging something that there is a network problem or something like that, I need to take care of it. That is the reason I am verifying my phone. Otherwise, I usually don't touch the phone during the class. Anyway, strategy is nothing but a bundle of tricks. It is not a bundle of tricks and magics. The reason is it involves careful planning and a systematic execution. So for that reason, it is not like an unplanned or unorganized activity, just like mantra, tantra, it will happen. No, it's a carefully planned, carefully analyzed, and it is formulated after considering many things inside the business environment. It will consider competitors, it will consider customers, it will consider suppliers, it will consider pricing, it will consider substitute products. After considering all these things, after careful evaluation of various aspects, then only we will prepare the plan. It is not like a mantra or tantra, which if we do a puja, it will get set right everything. No, it is not like that. Strategy is partly proactive, partly reactive. I told you with multiple examples already. We actually go into the business with the objective of proactively deciding everything. But unfortunately, businesses never work in that way. There will always be unforeseen changes or unforeseen circumstances for which you need to prepare a reactive strategy. Survival of the fittest. So this is one, like, in the explanation, they have used this particular statement, which is given by Darwin. Survival of the fittest says, it is not the strong person who will survive in the environment, or it is not the strongest, the person who with lot of resources, or the company with lot of resources, lot of bigger size. It is not such companies which are going to sustain in the market. Companies which are fittest, which means people who are adopting the changes very quickly inside the environment, they are the people who will survive for the long term. You might have seen n number of companies like Nokia who didn't adopt the changes on time and they were being killed. Even bigger giants, Nokia is the biggest giant. Biggest giants like Nokia have been destroyed completely. They have been strongest, but they have not been fittest. They have been strongest, but they have not been fittest. Fittest are the people who are adopting the changes quickly and then they can move forward. Companies will survive only based on their adaptability to the changes in the environment, but not based on their strengths, Anyway, so far what we have seen is definition of strategy and definition of management. And we have also seen certain concepts about strategy which are useful for our examination. Mainly, it will help us to better understand the word called strategy. Now, let us move into something called as strategic management. We are combining these two words. Management from action perspective, nothing but planning, coordinating, implementing. Strategy is nothing but long-term game plan. So long-term game plan implemented by the management is what is nothing but strategic management. Strategic management is managing the entity with the long-term game plan. Is nothing but strategic management. However, technically, strategic management has 5 steps. Mainly, these are the 5 steps which are there as a part of strategic management. First step is developing strategic vision and mission. We will understand what is vision, what is mission, and all these things subsequently in the same chapter. During that time, we will clearly explain what is vision and mission. But for now, you can understand strategic management is nothing but the first step in the strategic management is nothing but developing strategic vision and mission. From there, we need to derive goals and objectives, and various strategic alternatives or strategies need to be formulated. We need to implement that strategy and implement the changes, because always strategy, a part of the strategy is reactive. So we need to implement the changes and adjustments wherever it is needed. That is nothing but strategic management. So strategic management is nothing but we should have a vision. Basically, it is like this. Usually, the other management subjects and strategic management differs in this way. The other management subject also talks about goals. The other management subjects also talks about objectives. The other management topics also talk about managing the resources. However, strategic management, core and whole and soul, focuses on vision of the entity, and core and whole and soul focuses on being proactive most of the times. Though there is a part of the strategy which is reactive, but always management should work inside the organization for being proactive. And strategic management always says, whenever you have formulated the strategy and implemented it, keep on focusing, whether are there any changes in the environment, whether am I moving in the right direction. Always there should be controls inside the organization to ensure that we are moving in the right direction and to make changes for our action plan. So strategic management is nothing but, strategic management is an activity which will involve in 5 steps. The first step is we should have vision and mission. We should have goals and objectives. And the third step is we should be able to, based on this vision and mission and goals and objectives, we should actually formulate a strategy. For example, in Bahubali, what happened? They had a vision, goal, and objective of attacking Kalakeya. And further, they formulated a strategy called Trishula Vyuha. After formulating, Prabhas didn't go and sleep, or Rana didn't go and sleep. They actually implemented their strategy in the war. After creating goal, vision, objective, mission, and the strategy, they actually implemented their strategy. And during the implementation, there will be unforeseen changes. We need to adopt to those changes and then act accordingly. Whenever there is a change which is required, we should actually act accordingly. In simple terms, if we need to say, strategic management is nothing but strategy formulation plus strategy implementation plus evaluating continuously and ensuring that we are adopting the changes. 3 steps. Strategic management is strategy formulation, implementation, and then evaluating and ensuring that we are moving in the right direction. That's what is basically, in short, strategic management. We can get into certain discussions like, should every organization need strategic management? Without strategic management, can we function? And is strategic management the only alternative, or there are other alternatives of management styles? So these things are the next topics of discussion. So mainly, the next topic which we are going to discuss is why strategic management is important and what are the limitations of strategic management. I said you, Mukesh Ambani formulated Dhanadhan strategy and it didn't work, or it worked, but unfortunately it didn't give the expected results. So for that reason, that Dhanadhan strategy was extended by having the Dhanadhan strategy. So strategic management always helps you. The reason is you are going with a particular game plan for achieving the objectives, and this game plan will give you the framework for decision making. Will give you the framework for when you are taking every decision. When you are taking every decision, this game plan will support you. In Bahubali, when they were adopting Trishula Vyuham, now Bahubali, I mean, Prabhas will take certain decisions, Rana will take certain decisions, the Kattappa will keep taking certain decisions. But for all of their decisions, the framework which is helping them to take the decision is nothing but the Vyuham which they prepared, or the strategy which they prepared. What should I do at this point of time? What should Rana do at this point of time? What should Kattappa do at this point of time? All these things will come or will be coming from, I mean, it's a pre-prepared plan, right? What should I do at this point of time will be guided by my strategy. So my decisions, for my decision making strategy, if I have a strategy, I'll have a framework so that there is no confusion. Each person will not move into different directions. Each person, all of them will together their strengths attack the enemy, and they will be able to capture the opportunities or kill the competition very easily if there is a strategy based planning. If it is a simple organization, I mean, if I, let's say, in my organization, I recruited finance department, I recruited HR department, I recruited marketing department, and I told them, go start working. And if I don't set a goal, and if I don't combine all of them into one single direction, all of them will just get into their own action in different directions, and ultimately we will not be able to produce results as an organization. So strategic management is required for bringing everybody into one direction and then moving, for capturing opportunities, for creating. See, whenever there is a strategy, we are creating a proper defense for ourselves. Without a plan, if we go and attack, now what will happen? Let's say instead of attacking in 3 directions, if all of them attack in one direction in Bahubali, the enemy might attack in different directions and then we might lose our kingdom. So strategic management will actually provide a proper defensive framework as well. It is not about attacking always. It is also about defending from the competition. It also ensures that the competitors doesn't take over or doesn't kill or doesn't significantly reduce our business or significantly damage our business. So strategic management is always essential because of these reasons. So reasons are summarized over here. The importance, it helps in directing and help in achieving the objectives. It will provide a framework for all the decisions. It will make the management proactive instead of reactive. We will not wait for the change to happen. We will actually be the change makers most of the times when you adopt strategic management kind of a technique. It will help us to find various business opportunities before in hand and then pursue that opportunities. It acts as a defense mechanism against mistakes and pitfalls so that we will not, since there is a framework, we will not commit mistakes when we are actually implementing the strategy. Then there is a strategy. See, in Bahubali, we could have attacked the Kalakeya without strategy as well. But maybe probably when you have a strategic management and you have a plan, and then when you attack, you will survive for a long term. And strategy will never guarantee winning, but at least when you have a game plan and when you have decided this is what I should do in the future, you would have planned for a long term. So it will help us in continuing our business for a long term, and much importantly, it will help us in developing the core competency or competitive advantage. For now, you can understand both are same words, core competency and competitive advantage. It will give us an edge over the competition. Always, that is what has happened in the case of Reliance. Over Airtel, over Vodafone, over Idea, there were multiple mobile networks at that point of time. Jio's strategy helped them. What is Jio's strategy? Mainly the strategy was 180 days of free internet and free data, and voice is free for lifetime. Voice calls we are not paying on any network today. That is because of Mukesh Ambani's strategy at that point of time. So strategy will actually create a competitive advantage for us and will help us to survive with the business for a long term. So what and all have we seen so far? We have seen the definition of management. We have seen the definition of strategy. We have seen the definition of strategic management. Then we have seen the definition of we have seen the importance of strategic management. Now the next topic is limitations of strategic management. Do you think if there is a strategy inside the organization, we will win for sure? We will become the number one entity in our industry? No, that is not the case. There are certain limitations for the strategic management. For first limitation for the strategic management, usually preparing the strategies and all require a lot of time, lot of expertise, lot of environment elements should be considered. Time, expertise, lot of elements should be considered. Even after spending this much amount of time, cost, and elements, we may not be able to understand the environment properly. For example, the Xerox machines, you know, right? I mean, the Xerox is the company which actually came into the market for the first time with the photocopying technology. Photocopying is nothing but creating the same document once again. Xerox, though we call it as Xerox, Xerox is a company's name. Photocopying is the technology name. Xerox became so popular when it was launched. The reason is that was the only company which was offering this particular product inside the market. So people started calling that particular technology itself as Xerox. Unfortunately, today if you see in the market, than Xerox, 90% market share is with Canon, a company called Canon. Do you know what is the reason for Xerox losing the market share? Xerox didn't realize it for a long time. They appointed a consultant. They took almost 2.5 years to decipher this entire market, and then finally came up with a conclusion saying that Xerox is not able to perform because competitors are delivering the machines fastly, with high quality, quickly, at a better price. None of this is new. I mean, competitors, anybody who purchases the photocopying machine will look at all the alternatives in the market and will choose the best one. So that is a very simple analogy, but Xerox took 2 years of time to realize this. And by the time they lost their entire business. Like, you know, sometimes what will happen is when you hire too many consultants to prepare the strategies, to understand the competition, to understand the market, they take a lot of time to study and provide the report. By the time our hands are already burnt, our opportunity is already lost, our competitor has already killed us. Sometimes it takes a lot of time. It requires a lot of expertise. Even by spending all of this, we don't know whether we will get into a correct action plan. When we start implementing that action plan, suddenly COVID comes, unexpected, unanticipated environmental changes. All our strategy will go for a toss. There are so many limitations for strategic management because environment is complex, turbulent, and keeps on changing. It is a time-consuming process to create strategy. It's a costly process. It is difficult to clearly estimate the. Even if we prepare a best strategy, competitors might copy our strategy or come up with a better strategy. For example, Jio thought free voice calling might become the biggest competitive advantage for Jio. But unfortunately, within next 3 months, Airtel also announced free voice calling for lifetime. When Jio announced free calling for lifetime, within next 90 days, Airtel also announced free voice calling for the lifetime. We don't know how will competitor respond. So we need to keep changing our strategies. That's the reason. Though we sit and plan, draft long-term plans, pages and pages together, unfortunately, environment might throw a different challenge altogether upon you. And the strategy which you formulated all these days might go for a toss. So that is one big important demerit of a strategic management. Okay. The next aspect. So what and all have we discussed? Strategy, management, strategic management, importance of strategic management, limitations of strategic management. Then the next topic is strategic levels inside the organization. Usually, when the organization is of a very big size, when the organization is of a large entities, strategies will get formulated at 3 different levels. Let me explain it like this. For example, since we are talking too much about Reliance for a long time, so we can, in Reliance, when you take Mukesh Ambani doesn't have one business. Mukesh Ambani has a lot of businesses, not less than 100 different varieties of businesses. It's a conglomerate entity. What do you mean by conglomerate entity? Lot of businesses are there. So Mukesh Ambani sits at the top. And Mukesh Ambani, as a part of Reliance, there are 35 different businesses. Can you name few? For example, Jio is one division. Reliance Mart is one division. Reliance Mart is what we see the supermarkets here and there. Right? That is one division. Reliance Digital, which deals in electronic goods sale. That is one division. Reliance Trends, which deals in textiles and fashion. And then Reliance Gold, which deals in gold. Reliance Finance, which is a bank, an NBFC of Reliance, which is there in place. So all these are various divisions or business units of Reliance. Now you say me one thing. Are the competitors the same for every business? No, absolutely competitors are different for every business. For example, competitors of Reliance Gold are nothing but Tanishq, GRT Jewelers, your Lalita Jewelers. All these guys are the competitors for Reliance Gold. When it comes to Reliance Finance, Reliance Financial Institution, the competitors are nothing but Aditya Birla Finance or like TVS Finance or like other NBFCs, even the banks, HDFC, Axis, all these guys are the competitors for Reliance Finance. When it comes to Jio, the competitors are Airtel, Vodafone, all these guys are the competitors, BSNL, all these guys are the competitors for Reliance Jio. So in that way, for each of their business divisions, there is a different competitor, there is a different environment, there are different resources which are required to compete in that particular environment. And in each division, there will be multiple functions again. For example, if you take Reliance Jio, there is a research and development team in the Reliance Jio. There is a finance team in Reliance Jio. There is a marketing team. There is a HR team. In each and every business division, there are independent functional units again. So 3 levels of structure I told you. At the top, Mukesh Ambani and 5 or 6 people who are closely associated with him, who become the top management of Reliance Group. Reliance Group. I'm not talking about Reliance each division. I'm talking about Reliance Group. This is the top management or corporate level management of an entity. And under them, for each division, for each business, there will be a CEO or there will be management, a set of people who will be managing each division. For Jio, Mukesh Ambani's son is managing. For Reliance Supermarket, Mukesh Ambani's daughter is managing. For Reliance another business, Mukesh Ambani's other son is managing. So in that way, there are different divisions. For each division, there is a different set of management, and they are actually focusing on different industries. And in each business, in each division, there are again different departments. Now you can ask me a question. Sir, where should this strategy be formulated? Should it be formulated at the Mukesh Ambani level? Should it be formulated at the different businesses level? Should it be formulated at different department? Department is nothing but function. Function and department are the same words. Should it be formulated at the department level? Let me say, strategies should be there at all the 3 levels. Mukesh Ambani should decide on which industry he should enter, which industry he should not enter. If there is some amount of capital available, in which business unit should he invest? Where should he invest more? Where should he invest less? Which merger and acquisition I should do? All these things will be planned at corporate level. When it comes to the divisional level, for each division, we should plan. For example, at Jio, they should plan a strategy for their pricing, their competitive advantage. They should plan a strategy for their expansion, their global aspirations. So this will be the strategy at each division level. When it comes to the function, under each division, there will be multiple departments, right? At department level also, we need strategy. For example, finance department needs a strategy. Marketing department needs a strategy. HR department needs a strategy. Each of them, they need a strategy in line with the divisional strategy. So always the organization works in this particular manner. At the top, you will formulate a strategy. That strategy will get translated at each division as a divisional level strategy. And that based on the divisional level strategy, you need to prepare your functional level strategy at each department level. At each department level, all three strategies are very, very important for everybody to go together. If each strategy goes into a different direction, then organization will not achieve its goals and objectives. All the strategies should work in tandem with each other. They should go hand in hand with each other. So corporate level, functional level, and business level strategies should go hand in hand. Usually, in old syllabus, there was a topic, probably in somewhere around 6th chapter or 7th chapter, about organization structures. There used to be something called as horizontal structure, matrix structure, hourglass structure. There were so many structures which were discussed earlier. But now the topic is condensed into just a small paragraph of horizontal relationships, vertical relationships, matrix relationships. So usually, though we are saying the strategies at will be there at three different levels: corporate level, functional level, and divisional level. It depends on the nature of organization. Sometimes there will be horizontal relationships in the organization. It is also called as flat organization, which means a very small business. Let us take a small grocery shop near our street corner. Probably one owner will be there, and 2 to 3 employees will be there. One person will be responsible for cleaning, one person will be responsible for billing, one person will be responsible for packing. So these are the 3 employees. All 3 of them report to the same model. That's a very flat strategy. Here in this kind of organizations, you cannot have corporate level, divisional level, functional level, nothing. Only one level strategy that is formulated by the owner. Vertical relationships are nothing but organizations with 3 levels of management: top level, middle level, lower level. All these 3 levels will be there. Those kind of organizations, they need strategies at all the levels. Then there will be certain organizations called matrix organizations. What do you mean by matrix? Matrix is nothing but box. Matrix is nothing but box. In matrix, there will be 2 levels of control. One from the top, one from the side. One from the top and one from the side. For example, usually in our audit firms, we always work in a matrix structure. What will happen is, see, for example, let's say we have a client. Let's say we have a client called Tata Group. Let's say we need to audit a Tata Group. When we go for audit in Tata Group from our entity, let's say I am Deloitte. When we are going and auditing Tata Group, they will appoint a audit manager for Tata Group. So I am from taxation team. There will be another guy from, let's say, indirect tax team. There will be another guy from transaction advisory team. There will be another guy from internal audit team. There will be another guy from statutory audit team. All of us will have our own managers. As a part of taxation team, I have my tax head. As a part of indirect tax team, my colleague has another indirect tax head. We usually report to these guys. I always coordinate with my tax head. At the same point of time, whenever I am put into audit of Tata, all these people from different teams, some of them will come together and will go into the Tata Group for the purpose of auditing Tata Group. When we are auditing Tata Group, we will be reporting to the audit manager or the client manager of the Tata Group. Audit manager who is responsible for auditing the Tata Group. So indirectly, as an employee inside the organization, I have 2 bosses now. One boss is from my division and the other boss is from my project. One boss is controlling the project, one boss is controlling the division. That such kind of structures are called as matrix structures. Even in this structure, strategy is required at 2 levels, one at project level and one at divisional level. At divisional level, they have to plan for divisions improvement, division skill set and all this stuff. At project level, they have to plan for project timelines, delivery with quality and all these kind of things. So in matrix structure, the strategies will happen at 2 different levels. Okay. The next topic is vision. So if you remember, I told you there are 5 steps in the strategic management: formulating vision and mission, formulating goals and objectives, formulating the strategy, implementing the strategy, and ensuring that there are changes in the environment and they are being properly adopted. So these are the 5 steps in the strategic management. In that we will start discussing about the first step and second step here itself: vision, mission, goals and objectives. And regarding formulation of strategies, next 4 chapters, we will keep discussing n number of strategies in this syllabus. So there we will discuss about what are the different strategies which are applicable. Anyway, so now the discussion is about corporate vision. What do you mean by corporate vision? So one of the first steps in the strategic management. I'll give you 1 minute before discussing strategic corporate vision. let me discuss a term called strategic intent. Let me discuss this term called strategic intent. What do you mean by strategic intent? For every organization, there will be one base philosophy. There will be one base philosophy, and that philosophy is what is referred to as strategic intent. For example, Apple's base philosophy. They might have a number of strategies. They would have changed those strategies over a period of time. They would have entered into new products, new markets. Initially, they started off with laptops. Later, they entered into phones. Now they are entering into headphones. Now they're entering into smartwatches. Now they're entering into iPads. Later, they have entered into many multiple speakers and many multiple devices. But however, behind all these strategies, there is one intention behind all of them. They should have unique design. Their product should be of superior quality. They should be always number one in their category. So this is what basic intention of the management. This actually comes from the values of the founders, or values or what they believe. Founders, what they believe in. It comes from there. Strategic intent is nothing but the core philosophy or the entire base for the strategic management. Why should we exist in this business? What should we do in this business? It can be any business for that matter. Why should we exist in this world? That answer will be provided by strategic intent. Based on the strategic intent only, vision will come, mission will come, strategy will come, implementation will come, everything will come thereafter. But the core intention, for example, Steve Jobs, the founder of Apple, he provided the strategic intent to this Apple. The entire culture will actually come from the strategic intent. The entire objective, entire vision, everything comes from the strategic intent. Intent is nothing but the core philosophy which the management believes, the core philosophical base for the entire strategic management. Why do we exist? What do we want to do? Will be answered at this particular level. Based on this strategic intent only, our vision will come. Our strategic intent, what was the strategic intent for Apple? Apple's strategic intent was superior quality, number one products. Wherever we go, we should be at the top of that particular industry. Whichever product we launch, we should be at the top. World's best technology should be launched by us. So that was the intent. Superior design, superior quality, superior pricing, superior everything. That was the intention. Based on that intention, they formulated the vision. Our vision is to launch the mobile phones. Our vision is to launch the mobile phone with so and so feature. Our vision is to capture 90% of the market by so and so date. All these things are nothing but floating out of strategic intent. Intent is nothing but base philosophy. What does management believe in? For example, Tata Group's intent. What was the strategic intent of Tata Group? When J.R.D. Tata founded this particular Tata Group, the sole intention was to aid in the growth of India, to aid and to become a part of growth of India. So that was the sole intention. Because of that, they entered into 35 different businesses. The sole intention was we should be the drivers of the industrial growth in India. So based on that industrial growth, multiple options came in for them and they started moving ahead in that particular direction. Intent is nothing but the base philosophy of the organization is nothing but strategic intent. From the intent only, we will get vision, we will float vision, we will float goals, we will float objectives of the entity. Now let's discuss what is vision. Vision is nothing but where do you want to be there in the future? Mission, vision and mission, usually these two words, we think it is same, but they are different. Vision, where do you want to be? What kind of organization you wish to create in the future? That's what is vision. Mission, M-I-S-S-I-O-N, mission is nothing but where I am. What are my values is nothing but mission. Vision and strategic intent will actually coincide or overlap with each other. Vision is nothing but about the future. Where do you want to be? Where you want to stop? Where you want to go? Usually, whenever we hear the word vision, we always used to remember Abdul Kalam. Abdul Kalam always used to say Vision 2020 for India. Vision 2020, which he coined when he was president of India. He used to be president of India somewhere in 2003 or 2002. During that point of time, he used to work with the Vision 2020. What is Vision 2020 of Abdul Kalam? He said, by 2020, India should become a developed country. That's what was the vision which was established. Whether we achieved it or not is a different story. That was the vision which was formulated at that point of time. Where do we want to be? What kind of organization we wish to create is what is nothing but vision. Now, even Narendra Modi is working with a vision. He is working with a vision of 2047. He's saying Ajadi ka Amrit Kal. So 75 years are completed and only 25 more years are left for us to touch 100 years. This 25 years we will struggle hard, and by 2047 India will be one of the top tier economies in the world with highest per capita income. That's what is the vision which he is working towards. So what I am trying to say you guys here ultimately is vision is nothing but where you want to be, what kind of organization you wish to create. A statement is definitely, vision is nothing but a statement which is definitely to be communicated across the people inside the organization to help them understand where are we traveling towards, what is our goal or what is our ultimate objective, what is the thing which we wish to achieve is nothing but vision. Vision is nothing but a roadmap for the company's future. It provides specifics about technology, customer focus, geography, and product markets that we need to pursue. So, for example, what and all we should do. Our vision is to do so and so activity for reaching so and so place. The capabilities it plans to develop and the kind of company that the management is trying to create. Strategic vision is nothing but it is a statement which answers these two questions: where you want to be and what kind of organization you wish to create. Apple decided to create an organization superior in design, technology, pricing, competitive position, and everything. That's what is their vision. Vision is nothing but where do you want to be and what kind of organization you wish to create. Usually, if you articulate the vision properly, it helps in moving the organization into a common direction. Because if you don't know where we are going, let's say in Apple, if somebody is trying to, one person is trying to create cheapest phone, one person is trying to create the superior design with a superior quality. If each of them go into a different direction, nothing will work out. So for that particular reason, always strategic vision is very, very important inside an organization. What are all the elements or what will be the parts of steps in formulating the vision? The steps are nothing but first we need to understand who we are and where we are now. This is nothing but mission. First we need to formulate the mission and then we should come into vision. Vision is nothing but where are we going, where do you want to be, and vision should be communicated across the organization. It is not like you formulated the vision and you'll keep it inside. You have to communicate it across the organization. Okay. So what is mission? As I said, mission is understanding the current scenario. Vision is understanding about the future. Mission says who we are and what we do. Who we are, what we do, what are our values, and how are we different from others. These statements will be answered by mission. Vision is about future. Mission is about the current scenario. Vision is about the future and mission is about the current scenario. So you should always understand vision is nothing but where am I now? How am I different from our competitors? How am I different? What am I at present? What am I good at? What am I bad at? What is my values? What can I pursue? What I should not pursue? All these things are nothing but mission. And based on this mission, we will derive what I should reach in the future. That's called vision. So differences you can go through. Goals and objectives. So based on the vision and mission will only be one statement at the top level. At the corporate level, there will only be one statement, which is vision and mission. But however, that vision and mission should be translated in a relevant manner to each and every individual. They become goals and objectives. For example, at vision and mission will be there at Mukesh Ambani level. But however, I am a small employee at Reliance. How will that vision be related to me? I need to know vision, but at the same time, how will that be relevant to me? I am a CFO of Reliance or I am a small finance manager of Reliance. Mukesh Ambani is saying there to launch cheapest telecom. So as a finance manager, I should identify how do I price it. As a finance manager, I should identify what is the cheapest source of capital. As a finance manager, I should identify how can I bring in the cheapest interest rate loans so that we can ultimately offer the product at a cheaper cost. As a finance manager, I should identify how will I reduce the cost so that cheapest product can be offered to the customer. So that's nothing. Those are nothing but goals and objectives. Goals and objectives are at the department level. That vision and vision statement, which is established at the top level, will get translated into goals and objectives at the bottom level. Goals and objectives. Goals are nothing but open-ended attributes. For example, goal says I should grow. Objective says I should grow by 20% within 2024. So if there is something measurable, specific, then it becomes objective. Goal is nothing but an open-ended statement. However, if you see these two words, they are used interchangeably. Sometimes people say goal as objective, objective as goal. So we will not be able to say whether, I mean, only for the theoretical purpose, we will say goals are open-ended attributes, objectives are closed-ended attributes with clear specifics. But however, they are the words which are used interchangeably. My dear friends, this is a fast track class. So I'm moving a little fast just by giving you the overview of entire chapter. But however, let me say you in strategic management, always people score lesser number of marks in it is the easiest subject. But marks wise, people score very less in the strategic management for the main reason that one of the main reasons why people score lesser in the strategic management is nothing but uh, they expect a similar language to be reproduced in the examination. Whatever is there in the textbook, institute expects the similar language to be reproduced in the examination. So for that reason, you have to revise and re-revise this particular subject again and again. Only then you will be able to secure good marks. So for that particular reason, you should revise this subject again and again. Only then you will be able to secure good marks because the terminology is most important when compared to the content. Content anybody can understand after reading once, but you should keep repeating for getting the particular terminology. So in chapter number 1, as a summary, if I need to say, we discussed the definition of management, we discussed the definition of strategy, we discussed the definition of strategic management, we discussed the importance, limitations of strategic management, strategic intent, vision, mission, goals and objectives. These are the topics which we have discussed in the chapter number 1. Take a small break. We will get into the next chapter. Now it is 7:45. We will reconnect or reassemble at 8 o'clock and we will get into the next chapter. Thank you. I'll continue the session on this link itself. We will just take a small break of 10 to 15 minutes and then we will continue with the next chapter. Thank you. Okay, so my dear friends, let us continue with our class. Just now we have completed the revision of chapter number 1. Now, since we have only 1 hour more of time, and I feel maximum we will be able to complete revision of 3 to 4 chapters, may not be all the 5 chapters, because chapter number 1, I was expecting it will take 1 hour 15 minutes, but I think it has taken 1 hour 45 minutes for us, or 1 hour, I think 1 hour 20 minutes, 6:30 to 8 o'clock. So 1 hour 30 minutes approximately. So again, tomorrow there is a session for 3 more hours, or 2.5 to 3 more hours. So I think we will be able to complete another 2 chapters tomorrow. So technically we'll be able to see through the 4 chapters, but don't worry. These 4 chapters itself will give you the comprehensive understanding of strategic management, and I'll repeatedly keep saying one thing. Just watching fast track classes alone will not be sufficient. You should have practiced it earlier. Only then you will be able to see this fast track. And apart from these classes, you should definitely read the material. And other than that, you should definitely practice the MCQ questions from the institute material and case law studies, case law questions from the institute material. Only then you will be able to write the exam well. Now, instead of taking up the chapter number 2 or 3, I'm getting into chapter number 4 because this is second part of the class. And already there is too much of theoretical content which we have seen. So for that reason, just to make sure that some important and interesting topics are being discussed, I am getting into chapter number 4. So chapter number 4 is mainly divided into 2 parts. Mostly we will complete both the parts today, or if not, we will complete the second part tomorrow. The first part is about portfolio analysis, and the second part is about strategic choices. The strategic choices which are available at corporate level, business level, and functional level. We just now told strategies are established at 3 levels inside the organization, right? Corporate level strategies, business level strategies, or divisional level strategies, and the functional level strategies. This chapter gives us some examples of what are all the corporate level strategies, what are all the business level strategies, what are all the functional level strategies. And at the same point of time, there is a first part to the chapter which is even more important, which is nothing but portfolio analysis. First, before getting into the portfolio analysis, we need to understand this term called portfolio. What do you mean by portfolio? Portfolio is nothing but collection or group. So this first part of the chapter will explain us whenever you are into multiple businesses, what kind of strategies you should adopt whenever you are into multiple businesses. For example, Reliance, as we discussed, is into multiple businesses. Tata Group is into multiple businesses. Hindustan Unilever is into multiple businesses. TVS Group is into multiple businesses. Whereas Hyundai is into only one business. Apple is also mainly into electronics, only one business. So that way, when the company is having multiple businesses, it is called portfolio of businesses. For example, Tata's business is a portfolio of businesses. Reliance business is a portfolio of businesses. Hyundai's business is not a portfolio, it is just one single division. It is just car making business, they don't have any other businesses. So in that particular way, the first part of the chapter focuses on analyzing the entities which are into multiple businesses. Portfolio is nothing but collection or a group. Sorry, portfolio is nothing but collection or a group. It discusses about a business organization which is operating in multiple divisions. Okay. Why should we, before understanding portfolio analysis, why should we first of all understand portfolio analysis? The reason is, when you are into 30 different businesses, you should formulate strategies at different level in a different way. Strategies at each level in a different way. For example, strategy which is required for Jio is different from the strategy which is required for Reliance Supermarket. So that way, strategy should be formulated differently. Resources should be allocated differently. Competitive advantage for each level will differ significantly. So for that particular reason, you should understand portfolio. We should understand certain techniques which will help you to formulate strategies together for all the businesses. At the same point of time, you should always remember that one strategy may not work for all. You should have independently strategies for everything. Before getting into the strategies which are usually used for portfolio analysis, we will understand 3 different terms or important concepts. These 3 concepts will help us to understand the portfolio better way. One particular term is strategic business unit. What's the first term? Strategic business unit. I hope you are able to see my Excel sheet as well. I'm just opening the Excel sheet. Okay. So I'm explaining you a term called SBU, Strategic Business Unit. What do you mean by SBU? SBU is nothing but, for example, I am drafting Reliance SBU. Is Reliance Group. SBU is nothing but an independent entity within a particular portfolio is what is referred to as SBU. Group is also called as portfolio, eccentric. Now, you guys already know about Reliance portfolio. What are all the a group or portfolio will contain different SBUs. SBU1, SBU2, SBU3, SBU4, SBU5. So there will be so many. Put together set of SBUs is what is referred to as portfolio. Group of SBUs is called as portfolio. Each SBU will have independent strategy. Its resources are completely independent. Its competitors are different. Everything is different for each SBU. For example, if you take all these days all these times I was explaining Reliance Group. Now let me explain Tata Group. Tata's portfolio will involve multiple SBUs. For example, one SBU is Tata Steel. Another SBU is TCS, Tata Consultancy Services. Another SBU is Tanishq, Tata Gold. Another SBU is let's say Tata Salt. Another SBU is Tata Motors, where they manufacture cars and all. For each SBU, there is an independent CEO who is required. CEO or the person who is responsible for managing that SBU, definitely needed. And there are different set of competitors. For example, for Tata Steel, competitors are Jindal Steel, Vizag Steel. So these Hindustan Steels, these guys are the competitors. For TCS, competitors are Infosys, Wipro. These guys are the competitors. For Tanishq, competitors are Lalita Jewelers, Reliance Jewelers. These guys are the competitors. For Salt, for Tata Salt, competitors are different brands of salt. I don't know the other brands of salt, different brands of salt. I don't think anybody is as famous as Tata, but I'm not sure. Then for Tata Motors, for cars division of Tata, competitors are Hyundai, Maruti Suzuki. So these guys are the different competitors. So different management should be there. Different competitors should be there. For each SBU, there will be a different competitor. Then only we call it as an SBU. Different management, different competitors, and even the strategy will also be different. For example, Tata Steel has a strategy of offering a quality steel at a better price. TCS is known for innovation. Tanishq is known for purity gold. Their strategy is different over there. Tata Salt is known for distribution. They can distribute even to the smallest village in the country. Tata Motors is known for safety. 5-star safety rated cars are coming from Tata Motors. So that way, what I'm trying to say is strategy will differ, competitors will differ, a different set of management should be there. All these SBUs put together is what is referred to as Tata Group. All these SBUs put together is what is referred to as Tata. So we understood the concept of SBU. SBU is nothing but a unit of the company which have a separate vision and objectives. It can be planned independently from other businesses. It can be a division product line within the company. Each SBU, what are the features? It will have its own set of competitors. It will have a CEO who is responsible for its strategic planning and performance. SBU will have a separate CEO. Okay. So why should we identify SBUs? We identify SBUs because so that we can formulate strategy at different level differently for each SBUs. For example, let's take Hindustan Unilever. Hindustan Unilever is a company with a lot of FMCG products. What is FMCG? Fast moving consumer goods. So here, what I mean to say is In each SBU, it need not be that there should be a single product. There can be multiple products. For example, in Tata Motors, it is not one single Tata car. There are multiple Tata cars. There is something called Tata Altros. There is something called Tata Nexon. There is something called Tata Punch. There are multiple brands, multiple products can be there. In a similar way, Hindustan Unilever portfolio, I have given you as an example here. For example, for household care, I mean for washing, they have something called as Surf Excel, Rin and Domex. Personal care products, they have Clinic Plus, Lux, Dove, Lifebuoy, shampoo, like soaps and shampoos. For food and beverages, they have multiple products. For beauty and wellness, they have multiple products. So what I'm trying to say over here is SBU is nothing but set of products or a particular division which we can identify independently, plan independently, and it will have different set of competitors when compared to rest of the units inside the portfolio. That's what is SBU, a small 2 marks word. Then experience curve or learning curve. The second term in the portfolio analysis, the second term which we are understanding is experience curve or learning curve. Very simple, common sense topic. What it says is, whenever you keep repeating the same activity, the cost of conducting that activity will reduce. For example, if I produce only one phone, probably the phone might cost us, the production of this phone might cost us approximately 20 lakh rupees for producing only one phone. But however, when you produce 20 lakh phones, each phone can be manufactured at less than 5,000 rupees to 10,000 rupees. For example, if I'm manufacturing a pen, if I want to manufacture only one pen, it might cost me 10 lakhs. But if I'm manufacturing 10 lakh pens, each pen might cost me only 1 lakh rupees. When the volume increases, cost per unit will reduce. Simple economics or simple costing. You would have seen this in the costing as well. So the chart is like this. Average cost per unit will keep reducing whenever your volume keeps increasing. When you produce more and more, average cost or average production cost which is incurred for producing one unit will keep reducing. That is what is referred to as experience curve. I think it is a common sense topic. Because of experience curve, what is the conclusion which we draw? The conclusion is, usually larger organizations produce larger quantities. So larger organizations will have competitive advantage over the smaller organizations. Smaller organizations always will struggle because their cost will be high. Average cost per unit will be high in case of a smaller organization. But in case of a larger organization, because of economies of scale, because of repeating the same activity again and again, their cost will be low. So we should understand, in our industry, each SBU, where do we stand? Do we have a larger share in the industry? Do we have a smaller share in the industry? We should understand. Accordingly, we should formulate the strategies. So we understood two terms. One is SBU, the second one is experience curve. Third term is also very simple. Product life cycle. Third term is also very simple. Product life cycle. In our portfolio, which means in our group, there can be multiple companies. There can be multiple businesses. We need to understand which business is in what stage. Which business is in what stage for sure. For example, there can be some businesses which will be there in the initial stages. There can be some businesses which will be there in the maturity stages. So usually, a product life cycle says businesses will be in 4 different stages. There will be introductory phase, there will be growth phase, there will be maturity phase, and there will be decline phase. What do you mean by it? Depending on the nature of business, each industry will be in a different place. For example, if I take basic phones, these are smartphones today. These are smartphones. I'm saying basic phones with keypad and all. They were in the introductory stage during 1970s to 1990s. During 1970 to 1990, they were in introduction stage. After 1990 till 2010, they were in the growth phase. And from 2010 to 2015, smartphones were there in the market, but they were very costly. So even then, people were going ahead with the normal phones only, basic phones only. That was in maturity phase. Demand was not quite significantly increasing, it was flat. Now after 2015, nobody is buying basic phones. It is in a decline phase. So introduction, growth, maturity, decline. Every business or every product will undergo all these 4 stages. Now, it is very important for us to understand which place we are into at present. For example, if we have, let's say Tata Group has 5 different businesses. It has many different businesses. For example, SBU6, Tata Group has something called as Carrot Lane, which sells diamonds. Tata Group has something called as e-commerce entity. I forgot the name of Tata Click. Tata Click. It is nothing but Amazon's competitor or Flipkart's competitor. Tata Click is an e-commerce platform. Now, Tata Group should understand which business is in what stage. Which business is in what stage. Earlier, they also had something called as Tata Indicom. You remember Tata Indicom? It's a mobile network company. So which business is in what stage they need to understand in their portfolio. For example, Tata Steel is in maturity phase. Steel, there are no alternatives to steel. And today, there are no new competitors who are coming into the steel industry. It is a well-settled, mature industry. It is not that significantly demand will increase for the steel or significantly it will reduce. It will just remain flat or with a very minimal growth. It's a maturity industry. TCS is a growth industry because software, every day technologies, new technologies are coming in, it is growing. Tanishq Gold is also a growth industry. Salt is a maturity industry. Maturity. Like, no significant new competitors. At the same time, nobody will consume cages and cages of salt tomorrow. It is just a mature industry. Tata Motors, I feel it is a growth industry. Carrot Lane, it is a growth industry. Carrot Lane is diamonds. They sell gold and diamonds here. Same like Tanishq. Tata Click, they are in introductory phase there. I mean, industry is in maturity, but however, Tata Click is a very new entrant. It is almost a 5 years or 6 years old entity. It is in introductory phase. Tata Indicom, it's a telecom company. It is in decline phase. That's the reason they shuttered it down. Actually, in fact, Tata Indicom is not there today. They shuttered it down, and Tata Docomo was also shuttered down. Indicom and Docomo, they had 2 companies. Both of them were shuttered down by Tata Group because they incurred a lot of losses. So that way, in our portfolio, we need to understand which are all in the introductory phase, which are all in the growth phase, which are all in the maturity phase, which are all in the decline phase, so that we can allocate resources accordingly. There is no point in allocating more resources to the declining parts of our portfolio. We should put more amount in the introductory or growth phase. We should take out more profit from the maturity phase industries. We should take as much as profit possible from the maturity. We should start slowly disengaging, coming out of decline industries. We should put more money into introduction and growth phase industries. So that way, we should understand what will happen, which product of our portfolio is in which phase. During introductory phase, very few people will be there. For example, artificial intelligence is an introductory phase. So very few people are there in the market. Many competitors are trying to enter only now. So much of research and development is going on. So much of cost is being incurred on the R&D. That's what is research introduction phase. During growth phase, R&D is concluded to some extent. So many players will enter into the industry and competition will increase. Everybody will grow with a very high rate of growth. That's what is nothing but growth phase industry. For example, e-commerce is in growth stage now. Where more and more number of customers are coming and it is not an introductory phase anymore. Earlier it used to be introductory. People used to fear to place an order online. But today it is not like that. Anything and everything we are able to make digital payments. Anything and everything we are able to order online. It is in a growth phase. Too many competitors will be there. People will start focusing on cost advantage only. Maturity is stagnant industry. We reached almost a flat scenario. There is no significant growth. Too many competitors. That is when it is called as maturity. Decline is where demand is actually reduced. For example, newspapers are in decline industry. Maturity industry for steel, salt, these kind of things are in maturity industry. So this explains the features at each stage. So we finally saw 3 words in the portfolio analysis. The first word which we saw was SBU, strategic business unit. Second word which we saw was experience curve, or it is also called as learning curve. Third word which we saw was PLC, or nothing but product life cycle. SBU, experience curve, product life cycle. These are the 3 terms which we saw in this particular portfolio analysis. Now, very importantly, the same portfolio analysis, we will be discussing 4 strategies or 4 matrices, which are given by famous companies. One is BCG matrix. Second one is ADL matrix. Third one is McKinsey matrix. Fourth one is ANSF's product matrix. So we will discuss 4 different matrices. 4 different matrices, I can also say 4 different portfolio analysis techniques. 4 different portfolio analysis techniques. These portfolio analysis techniques are given by very famous companies like BCG. These are all famous top management consulting companies. We call Big Fours, right? In our auditing industry, Deloitte, EY, PwC, KPMG. All these 4 companies or 4 firms put together are called as Big Fours. These are the top players in our industry. In the same way, in the management consulting industry, there are some top companies. They have given these strategies, and in their name, we are studying their strategies. For example, the first strategy is BCG. It is given by a company called Boston Consulting Group. Boston Consulting Group. I'll explain you what does this strategy say. So this strategy says, divide all your businesses into 4 categories. Divide all your businesses into 4 categories based on 2 factors. You can see it from the picture as well. Based on 2 factors, divide all of them into 4 categories. One factor is market share, and the other factor is market growth. Other factor is market growth. So based on 2 factors, you divide all your businesses, because in your portfolio, in Tata Group's portfolio, there are multiple businesses. Divide all these businesses into these 4 categories. These 4 categories. Market share might be high, market share might be low. Market growth might be high, market growth might be low. So basically what they are saying is, market share is our business indicator. Whereas market growth is nothing but industry indicator. How is our industry performing? I hope you know the difference between industry and the business. Industry is nothing but, for example, there is something called, let's say, FMCG industry, fast moving consumer goods industry. This is an industry. There are multiple businesses in this industry. There is Hindustan Unilever, there is Dabur, there is Himalaya. These are all the various people inside it, Colgate. These are all the various people inside that particular industry. There is something called Procter and Gamble, P&G. In a similar way, there is an industry called software industry. Software industry is nothing but set of firms which are producing software. There is TCS, there is Infosys, there is Wipro, there is Cognizant, there is Accenture. So these are all various firms in the particular industry. So what BCG is saying is, based on your business, decide what is your market share, whether it is high or low. Based on your market growth, based on your industry factor, decide whether it is a high growing industry or a low growing industry. Whenever it is a high growth industry with a high market share, those businesses are called as stars. We have a very good market share, but however market growth is very low. Then these businesses are called as question marks. Low market growth but very high market share, these are called as cash cows. And the last one, very low market growth, very low market share, these are called as ducks. These are the 4 names which are given by BCG. BCG says, in your portfolio, take every business, put them into different categories depending on their market size and market share. For example, let us classify Tata's portfolio itself. Now let us take TCS. TCS is Tata Consultancy Services. It is in software industry. Is it a high growing industry? Definitely, yes. Yes, industry is very fast growing. Software industry keeps on growing always. Fast growing industry. Whether TCS has highest market share there? Yes, TCS has very good market share. In fact, TCS market capitalization is somewhere around $40 billion. Whereas the next company, second biggest company, Infosys, the market capitalization of Infosys is somewhere around 13 to 14 billion dollars. That is the difference. TCS is double to the second competitor, double to its competitor. So it is a star. So I can take as an example of TCS here. TCS is a star. Now let's say Tata Click. Tata Click is an e-commerce entity. E-commerce is a high growing industry. Every year e-commerce is growing significantly. However, Tata's share is very low here. That's called question mark. Question mark. Cash cows are nothing but very stable, matured industries. Matured industries where we have already significant market share. Market is not growing. Tata Salt, Tata Steel. Market is not significantly growing, but however, we have a very big market share. That is nothing but cash cow. Tata Steel commands approximately 30 to 40% of market share in India. However, steel industry is not growing very 30%, 40% growth in the year. No, it is not possible in the steel industry. Dogs are nothing but industry is also not growing. We are also not growing. For example, telecom industry, Tata Docomo. Industry is also not fastly growing. Already everybody has telephone. There are no new customers who are coming inside. If you see Reliance Jio or Reliance Airtel, they will not grow at 30% per year, 40% per year. No, it is not possible. But companies like TCS and all, they grow at 30% per year, 40% per year as well. But Docomo, no, not possible because industry is not performing well. Even our business is not performing well. So those are nothing but 4 categories. So now BCG says 4 different strategies for 4 different businesses. BCG says adopt 4 different strategies. Build, hold, harvest, divest. These are the 4 different strategies which TCS says, which BCG says. For businesses which are in low category, it says build here. Build. For these businesses, it says hold your position at the top. For cash cows, it says harvest. For dogs, it says divest. These are the strategies which are recommended by the BCG. For build in the sense, see your market share is very low here. In Tata Click kind of a business, your market share is very low. But for that reason, don't come out. Don't come out. The reason is market is growing very significantly. It's a high growing industry. So for that reason, keep investing more and more. Adopt new strategies. Keep growing there. That's what is built. Hold is nothing but hold your position at the top. This is a high growing industry. TCS is in a high growing software industry with a high market share. Hold, ensure that you are in the top position. Keep investing more and ensure that you are in the top position. Steel industry, no need to invest now again and again. You have already invested and you have a very good market share. But business is not growing a lot. I mean, it is not an industry which grows significantly. So in that case, keep reaping benefits. I mean, like start taking more and more profits out from there. The last business is there, right? Dogs. Industry is already not performing well. And you are also not doing great because your share is also very low. Better you come outside. That is what is dogs. So finally, BCG says, take your portfolio. Based on 2 factors, classify all the businesses into 4 categories. 2 factors are market growth, market share. Market growth and market share. Based on these 2 factors, classify all your businesses into 4 categories. Stars, question marks, cash cows, and dogs. Classify all your businesses into 4 categories. Star, question mark, cash cow, and dog. Stars are the businesses with high market growth and high market share. Question marks are the businesses with low market share but high market growth. Cash cows are the businesses with low market growth, however high market share. Dogs are the businesses with low market growth and low market share. Adopt 4 different kind of strategies: build, hold, harvest, and divest. So these are there, right? Cash cows and dogs. These are cash generators. Stars and question marks are there. These are cash consumers. How come? You need to invest more here in these two businesses. So they are cash consumers. But whereas in cash cows, you'll have continuous profits because it is a matured industry with a high market share. So take those profits out, cash generator. Dogs also cash generators because sell them off and make money. Sell them. Divest means sell them off. Sell them off and make money. So they are also cash generators. So that way, there are two cash generators in your portfolio. Take that cash, put it into cash consumers in your portfolio so that you can keep growing your businesses. This is what is told by BCG, a company called BCG. It is nothing but Boston Consulting Group. But however, let me say you, this analysis goes wrong sometimes. This analysis goes wrong sometimes. That is the reason why we have next matrix. Next matrix, which is nothing but which is nothing but McKinsey matrix, or it is also called as stoplight model. McKinsey matrix, or it is also called as stoplight model, or it is also called as 9-cell model. It is also called as 9-cell model. This is our next matrix. I'll say you where does BCG go wrong. BCG goes wrong because let us take Geo now. In case of Reliance, let us take Geo. Geo is with a high market share, but not in a very fast growing entity, not a very fast growing industry. So what will happen? Geo will fall under cash cows. Cash cows means it should reap the benefits. It should not invest further. Geo should not invest further. It should start taking out the profits a lot. No, that is wrong. The reason is today, though Geo, the industry may not grow very significantly. Industry actually may not grow 30%, 40% year on year. But however, if you want to survive in the industry, you should keep on investing more because competition is so fierce. You should keep on investing more and more. So what is the mistake which is done? The mistake which is done by the BCG company is it has taken these two factors. What are the two factors? Market share and market growth, which are too narrow in nature. Growth is just 1%. Growth alone cannot decide everything. And market share is also 1%. It cannot decide everything. So McKinsey matrix came into picture and they said, we will consider business strength and market attractiveness. They said, we will consider market attractiveness and business strength. This is an industry indicator. How is our industry performing? This is a business indicator. How is our business performing in that industry? How is our business performing in that industry? Business strength. The difference is very simple. You should not, here there are 9 cells in total. Here there are 4 cells in total. BCG, there are 4 cells in total. Here there are 9 cells in total. That is not the difference. The difference is the factors considered by them. Business strength and market attractiveness. In BCG, we have considered only market growth, which is wrong. Here we have considered only market share, which is wrong. Here these people are considering business position and market attractiveness, which is a comprehensive factor. See, industry is growth. Industry, whether it is good or bad, you cannot decide only based on the growth rate. You should consider all these things. Size, growth, future, price level, profitability, technology. Based on that, you have to say whether it is an attractive industry or not. But for that, you should not decide just based on the growth rate. Telecom industry may not be growing left and right, but however, it is an attractive industry to be because the profitability is there and you will have control. When you have telecom company with you, you will have control on the entire economy. And even the the commitment which you gave is very high there. Already you have invested billions of dollars. So you have to consider a lot of stuff, not just growth rate. Earlier, BCG used to say only growth, but here they are saying everything else. And for comparing the business position, BCG used to consider only the market size or market share. That is not the only factor. You have to consider how is it growing as well. How is my market share growing? How am I growing inside the business? So based on that, you have to decide your strategy. Strategies are again same. Invest or protect, harvest and divest. Strategies are like BCG only. But however, you should consider different set of factors for classifying the businesses, not just market growth and market share. You have to consider business strength and market attractiveness. That is the difference between McKinsey matrix and then BCG matrix. McKinsey matrix is also known as, these are all the different names. It is also called as GE matrix. It is also called as GE matrix. It is also called as top-light model, 9-cell model. It is developed by a company called McKinsey. It is developed by a company called McKinsey, so it is also called as McKinsey matrix. Let us get into the third matrix. So I said you the difference between BCG and GE is it replaces with the market attractiveness instead of just a market growth. It replaces with competitive strength instead of just market share. Just market share. So that's the main difference. The factors which McKinsey considers are more comprehensive. It is not just market growth, it is not just market share. Let us take next matrix, ANSOF's product growth matrix. It is actually given by a famous person called, famous management guru called as Einar ANSOF. He is actually known as father of strategic management. He is known as father of strategic management, Einar ANSOF. He has given this particular matrix called ANSOF's product matrix. ANSOF's product matrix. Forget now, BCG, McKinsey are all gone. Those are all different set of strategies. This guy is saying, when you have a product, depending on the scenario, you should adopt 4 different types of growth strategies. He says, everywhere we should grow. I mean, there is nothing called coming out. We should grow everywhere. But depending on the scenario, there are 4 different types of growth strategies, which he says. One is market penetration, one is product development, one is market development, one is diversification. He says these things based on 2 factors, whether it is an existing product or a new product, whether it is an existing market or a new market. Based on these things, he asks you to pursue different set of strategy. Existing market or a new market, existing product or a new product. When you are using existing product and penetrating into the existing market, you have to adopt a strategy called market penetration. For example, let me take Colgate here. Colgate is a toothpaste, which is an existing product, which is an existing market. India is an existing market for Colgate. They are trying to sell more and more in the same market. That strategy is called as market penetration. What ANSOF says is, if it is the same product which you are trying to sell in the same market, try to increase the number of times people use that product. Try to increase the quantity of usage of that particular product. Try to create new usage alternatives for that particular product. For example, what does Colgate say? Brush teeth twice in a day. What does Colgate say? Change your brush every 1 month once. So all these things are nothing but market penetration strategies. Again and again, keep on advertising. Again and again, keep on reminding the customers there is this kind of a product. Again and again, try to keep increasing the quantity in which you can sell that particular product. The same market, same product, you keep on selling again and again. It is called market penetration. He gives us ideas for penetrating more and more deep into the market. You keep selling the existing product to the existing market, to the existing customers more number of times. That's called as market penetration. Now, it is an existing market, but you have developed a new product. I mean, a new product has been developed. Then the strategy which you need to adopt is product development, or basically new features need to be launched. For example, phones. I can say OnePlus. OnePlus. It is a new product, but into an existing market. OnePlus. Phones, smartphones is a market which is already existing. But however, you came up with a new product. During that point of time, you have to focus on product development. Add new features, add new utilities, add new price points, add new designs, add new colors, add new taste, and then you will launch it into the market. It is called product development. You should focus a lot on the product development when you are launching it to the existing market with a new product. You have an existing product, but you are entering into new market. Then it is called as market development. For example, Domino's is doing market development. Domino's has a very good product called pizza. Very good product, existing product. However, this pizza is available only in the top tier cities now, metro cities or like top tier 1 cities now. But it is not available in the tier 2 and tier 3 cities. So they are planning to create a new market in tier 2, tier 3 cities. Even in the villages, like Pani Puri shops, they want to establish Domino's outlets over there. So it is nothing but you are getting into new market. When you are getting into new market with an existing product, you should do something called as market development. You should go there, give more number of offers to the people, create awareness about that particular product, communicate the benefits of that particular product. Say your history is so great. Already we are selling a lot in the metro cities. Come adopt this particular lifestyle. So that is nothing but market development. You should create awareness. You should generate demand in the new market for the existing product. That's called market development. So ANSF gives us ideas how to develop market. When you don't have an existing product, when you don't have an existing market, then it is called diversification. So ANSF says, just enter into multiple businesses. One of them will click. Because you don't have an existing product, you don't have an existing market. Nothing is there with you, starting afresh. Try 3 or 4 things. You will be able to click in 1 or 2. That is what is referred to as diversification. So ANSF, Einar ANSF, the father of strategic management, he has actually given 4 different ideas or 4 different growth markets for us, growth strategies for us. One is market penetration. The second one is market development. Third one is product development. And fourth one is diversification. He says, according to your business scenario, adopt a different strategy for different type of growth. I mean, you need growth. Growth is permanent. ANSF says growth is permanent for sure. For growth purpose, you can adopt different type of strategies. You can adopt different type of strategies depending on the scenario. So we have seen 3 matrices, Nana. First matrix is BCG matrix. It classifies businesses into stars, question marks, cash cows, dogs, and provides 4 strategies: build, hold, harvest, divest. Second is GE matrix, Nana. It classifies businesses into 9 categories, ideally, but the 2 factors which it considers are market attractiveness and business strength. Market attractiveness and business strength. And this provides 3 strategies mainly. I can write it here. Market attractiveness. Invest. When the business strength is high, I mean, medium is additionally, it is considered by, medium was not there in the BCG, but these guys have given medium as well. When it is a fast growing business in a very attractive market, invest more. Here also invest more. When it is a low scenario, protect. Protect is nothing but hold. Divest. Divest. Harvest or divest. Basically, when you are already into the business, try generating profits. If not, come out. This is McKinsey matrix. Next, the last one is, third one which we discussed was Einar ANSF. Here also there are 4 strategies. The last one, ADL matrix. Arthur D. Little. Arthur D. Little. His name is Little, but however the matrix is bigger. Matrix is bigger one. He gives us this strategy based on PLC, product life cycle. He considers industry factor as product life cycle and competitive strength. Industry, for the sake of industry, we should consider product life cycle. Competitive strength is business factor. Our business, how is it performing? Our business, in what stage it is? It is based on business factor, and industry factor is product life cycle. I already told you there are 4 stages in the product life cycle: introduction or introductory, growth, maturity, decline. There are 4 stages in any product life cycle, whereas there are 5 stages in combination: dominant, depending on our scenario, strong, favorable, tenable, weak, very weak position. 5 competitive strengths. I can say you an example like this. For example, for introductory phase, I will take AI industry. AI is nothing but artificial intelligence, chat GPT. So these kind of products are coming in, right? Every day, machine learning, artificial intelligence, AI or ML. This is an introductory phase. For growth phase, I can say e-commerce. For maturity phase, I can say telecom. For decline phase, I can say newspapers, physical newspapers. Dominant. Who are the dominant players in this particular AI ML industry? Today, currently, dominant player is ChatGPT. A little bit strong player is Google's Bard or Google's AI. Favorable position, there are many other players. Like for example, I can say Microsoft's Cortana. Even in Windows, Cortana will be there. I'll say Cortana. For example, this Cortana is there, right? This is Microsoft's company. There are tenable, weak, many multiple companies are there, small companies. They're all tenable and weak. E-commerce, who is dominant? Amazon or Flipkart, who's dominant. Who is strong? Even the next level players like Big Basket, all these are position. Favorable position with very little market share. I can probably say GeoMart. These guys are in decent position. Tenable, Tata Click, not clicking at all. Tata Click, very weak position. Very small companies will be there who will be shutting down now and then. And so these kind of guys are in very weak position. Maturity, even Zepto is also very weak as of now. Zepto is also very weak. Telecom industry, who are the matured players? Jio, Airtel are mature, dominant players. Strong player, Vodafone. Favorable player, no one is there. Tenable player, little bit better than weak, BSNL. Weak players, there are nobody, everybody exited the market. So there are no players, no more players then. Newspapers, dominant, probably Indian Express, Times of India, strong Economic Times. Even today, people read these papers. Favorable, yeah, there are many local newspapers, right? I think in Tamil also there are newspapers. In Telugu also there is something called Eenadu. So these kind of players. Tenable, weakest position, very low readership. Tenable and weak, there will be multiple newspapers who are ready to shut down. Those are all tenable and weak. So this matrix basically says, based on your product life cycle and based on your competitive strength, understand where exactly you are there. For example, let us take Domino's. Domino's in a growth industry. Pizza is a growing industry, and it is in a dominant position in pizza. When you are in a dominant in growth industry, keep investing more. But at the same time, let us take Docomo. Docomo is in a weak stage in a matured industry. So better to divest. So it gives certain strategies depending on the scenario where you are in. Either when you are in the dominant positions in a high growing industry, you should invest, build more growth, create competitive advantage, grow over there. But when you are in a decline stages, start divesting over there. So same build, hold, growth, same strategies, but however, matched according to the different scenarios. You need not remember entire matrix as it is, but you should be able to remember at least these. Broadly, if you list all of them down, there will be some 10 words. For example, fast grow is one word. Build barriers for other people to enter is one word. Act offensively is one word. Lower cost is one word. Attack small firms is one word. Grow with industry is one strategy. Find a niche, hold a niche is one strategy. Identify these kind of strategies, remember them, and match it accordingly. Give some context to it and then match it. Don't put decline, divest, retrench is nothing but reduce the size. Don't put divest at the top. Don't put divest at the top. What I'm trying to say is don't by heart. Just remember some of these strategies. Remember 8 to 10 strategies from there and mix and match those strategies with a little bit of common sense. Little bit of common sense. That is what is referred to as ADL matrix, Arthur D. Little matrix. ADL matrix. It is given by a famous management guru called Arthur D. Little, and he explained this particular. Dear friends, there are only 10 more minutes left. I don't think I'll be able to continue with the next part of this particular chapter. But let me give you the summary of what have we discussed so far. We have discussed experience though, strategic business unit, product life cycle. These are the 3 terms. And thereafter, we have discussed 4 matrices. What are the 4 matrices? BCG, McKinsey, ADL, and SUF. Here it was 4 categories based on market growth and market share. McKinsey, it was 9 categories based on market attractiveness and business strength. Here it were 4 growth strategies based on market and product. Existing product or existing market, new product or new. And SUF is, there are multiple strategies in SUF, 20 cells in total. However, it is based on PLC and competitive strength. My dear friends, usually out of this 7 topics, 4 plus 3, 7 topics, 1 topic will be there in the examination for sure, 100%. You can take your strategic management question paper, check for one of these 7 topics. If it is not there, if no question is there from this particular 7 topics, then return back your question paper because that is not your question. That confidently I can say 1 question will definitely be there from these 7 topics. So this is that important. That is the reason why we are stressing it a lot. Please ensure you guys are preparing this particular chapter well. We will continue our discussion in the next class because there are only 10 more minutes left. I don't think I'll be able to start off with the next one. We will continue the next part of the chapter in the next class and we will complete another 1.5 more chapter to 2 more chapters. So that 4 chapters will get concluded in this particular class. It will help you to prepare. All the very best. Don't waste your time. Very few more days are left. So count each minute and prepare well. Thank you. We will meet again tomorrow.